Welcome back to Investing Talk Podcast.
Today we're looking at DGXX.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When you look at the source material on DGXX, you're not looking at some stable, boring utility.
Not at all.
You're looking at a fascinating, really high-stakes turnaround story.
Yeah.
And it's focused on one thing: becoming an AI infrastructure leader.
Right. The whole thesis is this massive strategic pivot they're pulling off.
A rapid wholesale pivot. And, the most critical part, they are doing it entirely debt-free.
That debt-free point it's huge. We'll have to come back to that when we talk about expenses.
Oh, for sure.
But first, let's unpack this operational shift. Because the speed of it, just over the last 3 months, from August to October, that's what's got everyone's attention.
It's not just a tweak. They effectively took their Alabama mining facility and, turned it into a completely different animal.
A dedicated AI infrastructure hub.
Exactly. And it's not just the shift itself. It's the quality of the shift that matters.
Yeah.
We're talking about converting a facility from, crypto-style power loads.
Which are super volatile.
Right. Very interruptible. And turning that into a Tier 3 certified data center.
Okay, so for anyone listening who isn't deep in data center specs, what does Tier 3 actually mean for AI? Why is that such a big deal?
It's really the difference between, a server in your garage and a truly mission-critical platform. Tier 3 means guaranteed reliability.
Okay.
You've got redundancy in power, in cooling, networking, N+1 redundancy. It means you can do maintenance without shutting anything down.
So if you're an AI lab training a huge model, you can't have downtime.
You can't afford it. So this signals they are aiming for those high-value enterprise contracts, not just, cheap compute.
Which makes that 40 megawatts of critical power capacity they've got much more meaningful. It's now for high-performance AI.
Absolutely. And this whole operational shift goes beyond the building. It's in their tech, too.
The ARMS 200 platform.
They filed a provisional patent for it. It's their modular infrastructure platform designed to be deployed really, really fast for these dense GPU clusters.
And we know it's not just an idea on paper.
No, it's not vaporware. They've already locked in key purchase orders with Supermicro. And these are for the advanced NVIDIA B200-powered systems.
Now that's where it gets really interesting for anyone following the hardware. Securing B200s. Why is that such a powerful signal to the market?
Well, the B200 is, it's pretty much top of the line from NVIDIA right now. It demands a ton of power, up to 1,200 watts per GPU.
Wow.
But it delivers the highest performance.
Yeah.
And you can't just go out and buy them easily. You need capital, credit, and the right kind of high-density infrastructure ready to go.
So by locking these in, DGXX is basically telling the world they're serious about landing the biggest, highest-paying clients.
That's the signal. The immediate goal is at 40 megawatts. But the long-term vision they've put out there is much bigger.
They're talking about expanding toward 200 megawatts, right? And maybe even multiple sites.
Yeah.
Exactly. Which is, of course, incredibly capital intensive. And that leads us straight into their financials.
It has to. A pivot this aggressive needs the numbers to back it up.
And the latest quarterly numbers do show some really strong top-line acceleration. They reported $37 million in revenue for the latest quarter. But the growth rates in their key segments, that's where the real story is.
Right. Looking at the breakdown, colocation revenue, so data center services, it shot up 163% year over year in the first half of 2025. That's $9.57 million.
And even their energy sales saw a 127% jump in Q2. That kind of triple-digit growth tells you their shift is hitting real, immediate market demand.
Which led to that huge financial milestone you can't overstate.
The removal of the going concern risk.
Exactly. After all that spending, they finally hit positive adjusted EBITDA in Q2. It suggests the business model is, at least at an operating level, starting to work.
It's starting to stabilize.
Okay, that's the good news. The revenue's flying, EBITDA is stabilizing. But let's be blunt. How can you have that kind of growth while the company is still, hemorrhaging cash? And that's the tension point, right? You've hit it exactly. Despite that amazing top-line growth, profitability is a serious challenge.
The numbers are pretty stark.
They are. The net profit margin is still deep in the red at negative 58.85%. EPS is negative 30 cents.
Yeah.
It's the cost of doing business when you're executing a pivot this big and buying the most expensive hardware on the planet.
So the question is, how do they keep the spending spree going without taking on a mountain of debt, which is what usually kills these kinds of turnarounds?
And that's where their balance sheet isn't just a nice-to-have, it's their key competitive advantage.
Because they're debt-free.
The company is fundamentally debt-free.
Yeah.
0% debt to equity. In this environment where their rivals are stacking up massive debt to build data centers, DGXX has, maximum flexibility.
That's a kind of resilience. They're not spending money to service old loans, they're spending it purely on growth.
Precisely. And they have a solid runway. By October, their cash plus digital assets.
That includes their Bitcoin and Ethereum holdings.
Yes, 85 Bitcoin and 1,000 staked ETH. That whole pot was over $30 million. That liquidity lets them keep spending on the build-out without, an immediate panic.
So they have the runway, they have the revenue growth, and no debt. But it's still a race against time to turn that into actual profit before the cash runs out.
It is, which makes the next 90 days just absolutely crucial.
What are the big, concrete events that investors should be watching?
The first one is immediate, November 13th. The Q3 financial results. That's the first major validation point.
To see if that revenue acceleration kept up.
And to see if they're getting any kind of handle on the expense line while they scale.
Then, in December, we get the real proof points for the AI strategy.
The first ARMS 200 pod.
The commissioning of the inaugural ARMS 200 pod at the Alabama site. This is a huge operational step. It proves their modular tech works in a live Tier 3 setup with the B200s.
It's the validation of the whole strategy, really. It is. And right after that technical proof, their commercial strategy gets tested. January 2026 is the planned launch of the NeoCloud's GPU as a service platform.
Their retail offering.
Exactly. So the initial customer numbers, the pricing, the demand, all of that will be a massive near-term catalyst.
And outside of those scheduled events, there's a lot of chatter in the market that could create some serious volatility here.
A lot of speculation, yeah. If they execute on the tech, the next big question is, who are the customers going to be?
Can they land a big fish? That's what it comes down to.
Right. Rumors are swirling about strategic AI cloud contracts, maybe a long-term deal with a hyperscaler or a major AI startup. If they get one big anchor tenant for that 40 million BU, the whole valuation picture shifts instantly.
And you can't ignore the M&A chatter. It's so common with these fast-moving, debt-free infrastructure plays.
For sure. There's talk of interest from bigger data center operators or infrastructure funds. They might want to buy that B200-ready capacity instead of building it themselves over years.
There's also that December 30th ETF rebalancing.
A good point. Any kind of index inclusion could trigger forced buying from passive funds, adding a layer of institutional support.
Okay, let's switch to the technicals for a minute. Because despite all this positive momentum, the stock has been incredibly volatile. We saw a single-day drop of over 14% just recently. How do you put that kind of noise in context?
It's true. The stock is definitely prone to sharp moves. But even with that volatility, it's still holding within a pretty strong short-term bullish channel.
And some of the technical models are, well, they're extremely aggressive.
They are. Some models are projecting potential gains of over 150% in the next 3 months. That would put the price somewhere between, say, $6.80 and $9.67.
150% gain is a massive forecast. What indicators are behind that kind of extreme optimism?
It's coming from key momentum indicators. You're seeing a bullish divergence on the 3-month MCD.
Which basically means selling pressure is easing under the surface.
Right. Momentum is building even while the price corrected. And on top of that, the 200-day EMA, a major long-term trend indicator, it just flashed a buy signal.
So the short-term strength is starting to confirm a longer-term bullish trend.
That's the suggestion. But, you have to connect this to the broader market view.
Yeah.
Analyst consensus is mixed. 2 buys, 1 sell. Generally leaning bullish, but
the retail sentiment is what's really driving things.
It is. And that's a double-edged sword. It drives those fast run-ups, but it also fuels that high volatility we were just talking about. The signals are strong, but they're reflecting a very active, speculative trading dynamic.
So let's wrap this up by looking at the 2 biggest elephants in the room, risk and profitability. What are the fundamental risks investors have to be crystal clear on here?
The number one risk is just pure operational execution. They're trying to pull off a massive transformation on a really tight timeline. Any delay in getting those B200s, any failure with the ARMS 200 tech in December, that could seriously damage confidence.
And the financial risk, it's not just about the current negative margin. It's the cost of staying in the game, right?
Exactly. The AI arms race demands constant investment in the newest, best hardware. So can they control their operating costs while also attracting clients who are being courted by giants like Amazon and Microsoft?
And that's the core vulnerability. They have to fix that negative 58% profit margin, and fast. They need to turn that capacity into high-margin contracts.
And of course, with the 52-week range from under $1 to nearly $7. This is a high beta, high volatility stock. That's a serious trading risk in itself.
So, with all that said, what's the final verdict from the analysis? The overall thesis?
Despite all those very real risks, the overall rating from the source material is a bullish 8 out of 10.
And the rationale for such a strong rating, even with the big profitability question mark?
It's that unique combination of factors. You have the accelerating revenue that proves the demand is there. You have the smart, aggressive pivot into the highest growth part of AI infrastructure. And you have the massive runway provided by that debt-free balance sheet.
Plus the calendar full of near-term catalysts.
Right. When you put all that together, the risk-reward profile looks highly attractive, but with a big asterisk. Management has to execute perfectly.
So it's attractive for both short-term traders looking to play those catalysts and for long-term investors who are betting on the whole AI turnaround story.
I think that's right. The next 90 days really are a definitive test. It's a test of whether this AI pivot can finally translate all that high growth and heavy spending into sustainable operational efficiency and, critically, into consistent profit. That transition. That's the turning point that will decide everything for DigiPower X.